guys. So are you excited? Are you learning a lot? I need you to put some comments down there below. It is a requirement. So because I want you to engage, I want you to let me know that you have an understanding of what I'm sharing. I want to know any questions you have. And also, I may have asked this in the beginning, but let me know what state you're in. I think I had already asked that question, but just in case you haven't answered that yet, let me know what state you're in. So in case you have questions, I can Google specific for your state, okay? So we already talked about purchasing real estate using a realtor, purchasing for sale by owner, and or potentially going via assumption. So now let's talk about wholesale, lease option, and subject to. Okay, so these are all real estate investor techniques that investors use to obtain properties, to purchase properties, what have you. So let's start with the subject to because it's closest to the assumption. So what a subject to means is that you're going to take over the existing mortgage subject to what's already in place, right? So this can be a little tricky, just like the assumption. I'm not a fan as a realtor, but that's because I'm licensed. And again, what? I owe loyalty, obedience, accountability, skill, and diligence in negotiating a contract. So I can't do anything that would potentially harm the public. And a subject to has the same potential to harm the public as an assumption, meaning the mortgage company could speed up the loan and cause a due on sale clause, which would then make the full mortgage balance due by the seller at that time, right? So that means that they owe $200,000, the mortgage company's like, I want my money right now. Because in most states, in order for a property to transfer, it means a new deed is recorded, right? So anytime that you're doing a subject to the existing mortgage, meaning I'm stepping into Marvin's mortgage subject to his current conditions and I'm taking ownership, and then we go and we record that at the courthouse. Well, when that records at the courthouse, it puts a cloud on the title, right? So let me write myself a note. We're going to talk about cloud on title. We're not going to talk about it now. But what that basically means is it can limit Marvin's ability. I'm just throwing Marvin's name as an example. It can limit Marvin as the seller. It can limit his ability to transfer or sell the property to someone else because now it looks like there's a transfer of ownership and it didn't necessarily go the proper channel. So we'll talk about that more. But a subject to is just you taking over the mortgage subject to the current terms. You just start mailing in the payments. But in order to protect yourself as an investor, you go and record that at the courthouse of record because you want to prove that you have ownership. So if you and the seller had something in writing, an agreement, and you didn't have it recorded, it would be he said, she said, I said, they said. So he or she could go ahead and sell it, although you all had an agreement and you were the one making the payments, you wouldn't have proof of ownership. So that's how subject to works. A lease option to purchase, right? So I get this question all the time from buyers who either aren't credit ready or maybe don't have the money to purchase, or they're self-employed, so therefore they can't easily get a mortgage because they haven't made themselves employees of their company. And so because they're not employees of their company and they show up as 1099s, most people that are 1099s have a lot of write-offs, right? Because we want to write off as much as we can so that we don't pay our good old Uncle Sam all of our money. But how that hurts the 1099 individual is that now they're showing a loss, although they may be making $100,000 a year or $80,000 or $200,000 a year, but they have $250,000 in write-off or $125,000 in write-offs. It makes it look like their business isn't making money on paper, and that's all the mortgage company can go on. They can't go on, but look, I have all this money I made. They can only go on your tax returns, right? So what the lease option to purchase offers an investor or offers someone to do is let me rent it first with an ownership agreement, right? So let me lease it, let me rent it, just like a lease and rent is just an interchangeable term, right? Let me lease it first for a year, get myself credit ready and in position to purchase it. And then at the end of that year, 2 years, 3 years, whatever you all agree on, I'll buy it. Right? So in the government, and I forget when and I forget what rule it is, and you'll have to research this to see if it's still the case for your state. but they don't allow lease options as a one contract, right? A lease option to purchase now cannot be a contract. They used to have lease option to purchase agreements, but they were so messy. It was like that piece of candy and that sticky piece of gum at the bottom of your grandma's pocketbook with hair on it. That's what I like in short sales too. That's what I like in some of these creative deals too. Just too sticky and messy, right? So they got rid of where you could do a lease option to purchase all in one transaction. So how it works now is you have a property that you want to buy from the seller. He wants you to buy it, right? So he has to create a lease first. Here's the lease between Garlinda and Marvin for a year. And then here's the offer to purchase contract, which is a second document. And so now Marvin and Garlinda have a lease agreement, and Marvin and Garlinda have an offer to purchase agreement, and all the terms are listed. Nobody can change the terms next year or at the end of the year. As long as Garlinda is able to get funding, financing, and a loan to move forward to pay Marvin, everything's already in writing. The other reason why the government did away with the one document lease option to purchase is technically, if it was done properly, in order for Marvin to get his property back, after he had agreed to lease option it to me, he would have had to foreclose on his own property to get me out as a tenant, to then take it back over and then go ahead and do whatever he was going to do to it. So it created a hotmess.com. So I recommend all these, creative financing arrangements. I recommend you get your money, you get it together, get your credit right, and you move on and you go on, right? Or create a partnership agreement with some people you can go into investing with. It's just easy and it's clean, right? Another way that you can purchase is a wholesale deal. Okay, so how wholesaling works is, let's say that I have a property and my friend Steven has a property, right? I'm sorry, I have a property and my friend, let's not use me. Let's say my friend Steven has a property that he wants to sell, right? And I'm interested in being a wholesaler. So how a wholesaler makes their money is, my friend Steven has the property. I'm a wholesale investor, which means I may or may not have any money to put down, but I know how to create a deal. So I go find a buyer. So Steven and I agree on a price. So Steven, okay, you want $80,000 for your house, right? Right. If I can find you a buyer for $100,000, would you take the $100,000, you get your $80,000, and my wholesale fee is the $20,000. The $100,000 the buyer agreed to, the $80,000 you said you wanted, and I get 20. Are you good with that? Yes. Okay. So now I take Steven's property. I begin to market Steven's property on the open market, right? On the for sale by owner sites and anywhere else, social media, marketplace, anywhere else, Craigslist. I can put his property to market it for him. We have an agreement. He understands that I'm gonna make money in between him and the buyer. So now I go and I find the buyer. That buyer gets a loan. They go through the traditional lending process, right? And then once we're all sitting at the closing table, my $20,000, if the attorney or title agent, wherever you're closing, whatever your state uses, we're an attorney state, some states are title company states like California, wherever you're closing, it's denoted in there that the seller owes me $20,000. Now, if it can't go on the HUD and settlement statements, we'll talk about what those are in a different video. If it can't go on the closing disclosures at closing between the buyer and the seller, Steven and I have a side agreement that says you're going to pay me $20,000 because I brought you this buyer client. Now, why wouldn't they just go get a realtor, right? So most wholesalers will market to sellers saying, hey, you don't have to pay realtor fees. You don't have to pay realtor commissions if you come and work with me and let me sell the property for you. Yeah, but you just gave this dude 20 grand, right? It doesn't make sense. But to a seller who is not against realtors, but doesn't want to work with realtors, they're anti-realtors, right? That sounds like a good deal to them. But think about what I shared in the last video. $80,000, and let's say the commission was 3%, on the high end 6%. Steven would have given me as a realtor at a max $4,800, but now he just gave an unlicensed person representing him not even representing him, an unlicensed person listing his property, and he just gave him $20,000. Make it make sense, right? But it's done every single day of the week because why? Sometimes wholesalers, when they reach out to these people, these are properties that maybe need a whole lot of work, that the only investor that they're going to be able to find, the only person they're going to be able to find that will buy this, only person the seller would be able to find to buy the property would be an investor, and that wholesaler has a list of investors that they work with. So therefore it's a win-win deal for both of them. They don't have to worry about somebody coming to ask for repairs. They can sell the property as is. It's no big deal. Everybody's happy. Everybody wins. So let's circle that. So we've talked about wholesales, lease options, subject to, we've talked about assumptions, we've talked about for sale by owner, and we've talked about using a realtor. And I've also shared with you what the pros and the cons are to each. Let's talk about what is a cloud on title. Okay, so a cloud on a title, when you're going to purchase a property, you got to do your due diligence, right? What is your due diligence? Is anything that you would need to know that would adversely affect you in the future once you get under contract and once you go to closing on this property? You got to do your due diligence, right? That's in the form of a home inspection, an appraisal, a wood destroying insect report. So the home inspector and the home inspection is the process where you pay an inspector to come out and check all the systems, the plumbing, the electrical, the wood, the windows, the dishwasher, the refrigerator, the stove, the gas, the HVAC, the heating and air system, the hot water heater. They check everything in the home, but they can only tell you what they can visually see that they inspected that was wrong with the property, right? They can't make recommendations. They can't give you any information outside of the scope of their profession, which is an inspector, right? Then you order an appraisal. The appraisal, you don't order it, right? But if you're paying cash, there's no appraisal, and you have the option of doing an inspection if you want to or don't want to, right? If you don't want to spend the money but you know somebody that's an inspector already and they want to do you a solid, right? You can have them come out and inspect the property for you. Anybody using a loan, any type of government-backed loan, FHA, VA, conventional, USDA, home equity line of credit, any type of loan you're borrowing from the bank, or if you're using a hard money lender, any funny money, right? If you're doing any of that, they are going to require an appraisal. Why? Because an appraisal determines the value of the property and ensures that whatever you've offered to pay isn't more than the property is worth, right? So the appraisal is always ordered by the lender, the person loaning you the money, and it's always ordered most of the time through a third-party vendor or a third-party portal, and that's so it can't be tainted, right? So I've shared with you, I came into the market on a crash. So during the crash, people were doing just all kinds of janky stuff. So for example, if I had a buyer client and the buyer had ordered, their lender had ordered an appraisal on the home they were purchasing, the seller or the seller's broker maybe would go over there and meet the appraiser and say, hey, I need this house to appraise at $350,000. That's the amount of the offer. We can't have any shortcuts in there, so don't come cutting the appraisal short because my client will lose money. So they were able to go over there and finagle and do all these janky things with the appraiser. The government was like, cut that out. No, we need truth in lending. So therefore, the appraisals are all done through a third-party verification system. Nobody talks to them. Nobody sees them. They schedule their own appointments. They go out. They send it back. Well, right now, where we are in the market here again, May 16, 2023, we are in a multiple offer situation. We're post-COVID, right? So post-COVID, there's still a housing shortage, which there already was low inventory. Now there's even lower inventory. So now we have a multiple offer bid situations across the country, right? Some homes have 5 offers. I've seen homes with 30 offers. I've had friends say they had homes that had 50 offers, which is ridiculous. At some point, just take an offer, right? And all that's leading to a lot of different lawsuits. But when there's multiple offers like that and you're in this feast or famine type market, most people are offering over the appraisal value anyway. So they are having the appraisal, but technically I'm like, why are you even paying for an appraisal? Because you've already agreed on paper via contract to pay over anyway, right? But so right now, appraisal really is like a big whoop. Where before it really made a big difference, but now people are paying over the appraisal value, so it doesn't even matter what is coming in at, okay? So that's just something to keep in mind. So the home inspector goes out to look for condition. The appraiser goes out to determine value, and then your wood destroying insect report, we lovingly call it a WDIR, it's wood destroying insect report, and they're checking for termites, post beetles, post infestation, current infestation that's undetected. They're going to go out and they're going to check the perimeter. They're going to check the perimeter of the home. They're going to check the garage. They're going to check the inside, and they're going to check any detached structures like a shed or an outbuilding, depending on your loan type, right? That's not always required, but depending on your loan, the wood destroying insect report is only required for FHA and VA loans, right? Conventional, it's not required. USDA does require it. So you also want to think about whether or not you're purchasing a home on a well, right? So wells can be a little bit tricky. And so when you're purchasing a home on, as a matter of fact, let's talk about that in a different video. Let's stop right there because I don't want to go too far. I think I want to put inspections and appraisals and all that jazz in a different video. So we've already covered it here, but I'm going to touch on it in the next video. So carry on. Love ya.